Hello, everyone, and thank you for taking the time out of your day to spend a few minutes with us as we kick off the beginning of a new video series where we will explore a few different topics within personal finance. There are a few popular topics around personal finance that are constantly circling among people, and we plan to touch on a few of them in the coming months through videos such as this one today to share our thoughts. We hope you find this information interesting, and if you ever have any questions at all as you're digesting these videos, please do not hesitate to reach out. So with that being said, why don't we go ahead and jump on in with today's discussion? I'd like to start with a brief overview. So what is personal finance? This illustration you see on your screen is how we envision personal finance. It has a lot of moving parts, but in a way, all these components you see have to speak to one another in order to not only be an efficient, but also an effective financial plan. And that's our job. We spend a lot of time working with our clients on an everyday basis, diving deeper into these topics. Another thing I will say in this same vein is if there is one thing that bleeds throughout all of personal finance and influences every moving part, it is cash flow. And you will notice how cash flow is at the forefront of everything we discuss in this video series. So the first topic we're going to discuss is the different investment accounts that are available to you as an investor. More importantly, how to best optimize the use of the dollars you earn with these different investment accounts. So starting with the top, as you'll see here, employer-provided retirement plans. So most employers offer the opportunity to contribute to a 401k or a Roth 401k. And I'll just mention I've listed the contribution limits here as well as the tax treatment for each account. So with that in mind and cash flow in mind, the first thing we're thinking about is how do we get free money? There is a strong advantage to contributing to an employer-provided plan because there is usually an employer match if you contribute enough. We want to ensure the client contributes enough to get the company to match their plan, if it works within the client's cash flow, of course, and if the employer contributes to that plan. And keep that point in mind because there's one caveat I will share, and that is if your employer does not provide a match, or if you're not eligible to participate in that plan, you may be surprised to hear that we may not recommend contributing to that employer plan, as that same money may be able to be invested in another one of the options you see here below and have the capability to be invested across more investment options than what is available in your employer plan. So the almighty question, how do I decide which plan to contribute to? Deciding whether you should contribute to a Roth 401k versus a traditional 401k is relative to what you are earning now and what you may be earning in the future, just because of how the accounts are treated from a tax standpoint. And we make that recommendation on a case-by-case basis, depending on your income. Moving down the list, you have your individual retirement plans. So you have the option of opening one of these accounts, which can either be a traditional IRA or a Roth IRA. And I've included the contribution limits for these accounts here as well, and the tax treatment for each one. So you must be earning an income in order to contribute to either of these plans. And there are income limits specifically for contributing to a Roth IRA. Now, we see clients can contribute to a Roth IRA in their lower income years before reaching the phase out that you see here listed to take advantage of that tax-free growth if their cash flow permits them to, of course. As far as the traditional IRA and the backdoor Roth option you see on your screen, we're going to explore an example where a client may utilize both of these accounts in our next video series. So please stay tuned for that. So moving down the list, again, next you have what's called a health savings account or HSA. So you have that option, which is another account to take advantage of to reduce your taxes. There are no income limits on contributing to an HSA. So your contributions and the growth in the account can be used tax-free on qualified medical expenses at any time. So essentially you can contribute to an HSA up until age 65, at which point you are become eligible for Medicare. It is unlike an FSA in that you can keep an HSA forever. With a FSA, you have probably heard of the term use it or lose it, meaning if you contribute to a FSA throughout a calendar year and you do not use the money for medical expenses in that same year, you forfeit the balance and the money does not carry over to the next year as a HSA does. So usually we are recommending HSAs over FSAs. And lastly, everyone, you have the opportunity to open something called a brokerage account. This account's main advantage is the flexibility it offers that the retirement accounts cannot, which in other words, your money is tied up with those retirement accounts until certain thresholds are met. On the flip side, the catch with a brokerage account is that when you're selling at a gain, you are taxed at capital gain rates. Whereas in these retirement accounts that we just reviewed, when you rebalance or place trades in the accounts, you are not taxed. And you either are not taxed indefinitely, like with the Roth IRA, because you paid the tax in the beginning when you contributed, or you're not taxed until you take a distribution, which would be in a traditional IRA because of the tax deferred growth. So as I stated before, we plan to visit these investment vehicles in our next video series and showcase an example or two of how they are working for clients in different ways. So everyone, with that concludes today's first video. We hope you found the content helpful and interesting, and we'll see you back here in a few months to dive back into personal finance. Thank you so much for joining.